you don't want any strategy that or any approach that you take to invest in to be driven by tax benefits. You want it to be driven by what is the best strategy for you as an investor for your overall financial profile, and what's the best way for you to maximize your profits. From there, I think after that, it makes sense to start to look at what is the best tax position for you to take and minimize your taxes and maximize your profits from that point on.
Welcome to CREPN Radio for influential commercial real estate professionals who work with investors, buyers, and sellers of commercial real estate coast to coast. Whether you're an investor, broker, lender, property manager, attorney, or accountant, we're here to learn from the experts.
Welcome to Commercial Real Estate Pro Network CREPN Radio. This is episode number 90. This is the podcast where we focus on investing in commercial real estate. We do this through weekly conversations with commercial real estate investors and professionals who provide their experience and insight to help you grow your real estate portfolio. Thanks for joining us. My name is J. Darren Gross. In just a minute, we're going to speak with Patrick Camuso. Patrick is a CPA focused on working with real estate investors. He's tailored his business so that he can work with investors located anywhere in the U.S. If you are a taxpayer, you likely just either filed and paid taxes, or you probably filed an extension. And so I thought this might be a timely or a good time to discuss the possible taxpayer real estate classifications. We get into this and the benefits and requirements of each with Patrick. But first, a couple of quick things. If you are on social media, reach out and let's connect. You can find me. I'm on LinkedIn, Facebook, Instagram, Twitter, and Snapchat. Look me up under, it's J. Darren Gross. That's the letter J, Darren, D-A-R-R-I-N, Gross, G-R-O-S-S. And the J stands for John. Mom and Dad never called me John, so Darren is my name if you're reaching out as a friend, Darren. You can also follow the show on Twitter at CRE Pro Network. And if you're on LinkedIn, be sure to check out our group. It's Commercial Real Estate Pro Network. All right. It's a great place to network with commercial real estate professionals. All right. Let's get on with the show. On the line, we're fortunate to have my guest, Patrick Camuso. Patrick is a CPA with Camuso CPA, PLLC. And he's focused on real estate, and we're excited to have him today. Patrick, how are you doing?
Doing great, Darren. Thanks for having me on. I appreciate it.
No, thanks for joining us. I'm looking forward to our talk today. Before we jump into it, though, if you could do myself and the listeners a favor and tell us a little bit about your background, and we'll go from there.
Absolutely. So before starting Camuso CPA, I worked about 5.5 years in one of the top Big Four accounting firms, specifically in the investment management and real estate space. After working there, I started Camuso CPA. We serve clients both locally in the Charlotte area and also across the country on a national basis. So working in the Big Four, serving large institutional investors, and then serving individual investors nationwide, I've had an opportunity to see what works with the traditional client service methods and what doesn't work. And what I've done with Camuso CPA is design a company to eliminate the biggest issues that I've seen and really tailor a service to the real estate community.
Got it. And so you're in Charlotte, is that North Carolina or South Carolina?
Charlotte, North Carolina.
North Carolina. So that's, I guess you guys, a lot of hockey down there, right? Or is that basketball, right?
Well, actually, we got a football team, a basketball team. It's a growing and vibrant city. A lot of real estate going on here.
Gotcha. Well, is that not where UNC and Duke and all that, are they near there? Am I thinking right? Or
Duke is about 2 hours from here, and UNC is close to here.
Okay. Well, it's
but what else is actually close to Charlotte is the U.S. National Whitewater Center. It's the Olympic Training Center for whitewater kayaking, and that's what actually brought me to the city because I like the whitewater kayak. So that's about 15 minutes from where I live in Charlotte. So that's where I spend most of my time when I'm not working on CPA.
Got it. Well, that explains everything now. I've seen some of your posts, and it all makes sense now. So that's great.
Absolutely.
Got it. Well, I'm excited to talk to you today because probably like most of us, if we didn't get our taxes filed here recently, we're on extension, and it will be happening again here. But it's clear when you're doing your taxes that some planning can really make it easy. And with real estate, there's lots and lots of record keeping that's required in order to get some of the benefits of real estate investing. And so I'm looking forward to talking to you a little bit about this and diving into kind of, and I think if this works for you, if we can talk about the different classifications of a real estate investor, I think that's helpful, because I think most people when they're getting into it, they're probably, if they're working a job and they're getting into it, I would assume there's a classification that they would be, as opposed to if they were a realtor. Or a developer or something like that. So does that sound like something we can walk through?
Absolutely, definitely, and you're right on point with that as well.
All right. So why don't we start off with the new investor, somebody that's just getting into it, that's working a job. Can you tell us a little bit about what they would be, or how they'd be affected by taxes, or things that they would need to be concerned with?
Absolutely. Well, for new investors especially, the real estate professional status is a subject of concern, because a lot of times when you're starting out, you have greater losses than individuals that are more experienced in real estate and start to realize gains. So you want to make sure that you can capture as much of that loss as possible on your tax return. So taking maybe one step back, there's 3 levels of classifications for real estate investors. The first classification is a passive investor, and that's really the least beneficial category from this perspective. And what that allows you to do is to deduct all of your passive losses against any passive gains that you make. So to go back to the first example of someone that's working a job who is not meeting the requirements that we'll probably discuss a little bit later of being an active investor or a real estate professional, they could only deduct any real estate losses and any depreciation that they take to the extent of the gains that they're making on the real estate.
So you've got, say, an apartment building or a even a single family, whatever your income is. That's the cap on your loss. Is that right?
Yes, but now what's interesting is maybe an example actually would a fact pattern with a client I'm working on now would be the husband has a W-2 job. He's a high earner, and they have a couple rentals, but the wife is a stay-at-home mom. Now you can very easily work with a couple where one of the either wife or the husband isn't working a full-time job to qualify them for these additional categories to allow them to take more losses to count against the W-2 income that their spouse that's working is making. So that would bring us to the next 2 categories of the real estate professional status.
All right. Yeah. And let's talk about that and specifically these income limitations and how they play out.
Definitely. So the second classification is as an active investor, and this would allow the taxpayer to deduct an additional $25,000 of losses against ordinary income. And now these do have phase outs, and I think that's what you're alluding to. So if you're a single individual, that would start to phase out at $100,000. And if you're married, the phase out would be at $150,000. But to qualify as an active investor, you would have to materially participate in the real estate activity. So what that would look like is a couple things. One thing, you have to own at least 10% of the real estate property. And you also have to actively participate in the management decisions in a significant sense. So you have to be the person that's determining the rental terms, determining the criteria to screen new tenants, budgeting and improving expenses, etc. You can't just basically say, hey, this wife has no income and she's working all these hours. You have to be able to substantiate this and say, these are the duties that the taxpayer is performing to qualify for this status.
Okay. Let me ask you on that. So, and maybe, I'm gonna stop. I'll hold my question till later because I'm thinking about the person that we're talking about actively working. But at some point, if you're retired and you're doing this, would you essentially be considered active, or would that put you into a professional?
Well, then the third status, that would bring us to the professional status, which is the most advantageous then in terms of losses. Okay. And that could be for when you're retired, or you can also, again, qualify a non-working spouse as this. So it could be a very strategic tax planning tool. Now, to qualify for this, again, you have to meet two qualifications. You have to spend the majority of your time working in real property business, which we can get into what that is in a general sense in a little bit. And the other qualification you have to meet is that you have to spend 750 hours or more working on that business in a significant capacity. That would allow you to deduct an unlimited amount of losses against your income.
Okay. And when you say majority of your time is the minimum 750 hours? Is that?
Yes, the minimum.
Okay. So you could essentially be like an insurance broker and also a real estate professional. Could you do both?
Yes, you could do both, but you really have to make sure that you're meeting the 750-hour requirement and that you're doing it in approved activities. So real property business and trade activities, it's a pretty broad definition, and the IRS doesn't really give clear-cut examples. But what that looks like is anything to do with brokering real estate transactions, developing or redeveloping, leasing out the properties, constructing them, and managing or operating them. So really anything to do with working on the property, you could use to qualify for these hours. And additionally, you don't necessarily have to be the person hammering the nail on the property either. You can be overseeing this work. You could be planning the work, planning all the details around how the work's going to be performed, and then hiring people to do it. But you do have to be spending enough time in those processes to meet the hourly requirements.
So if you're coordinating the crews, or if you're essentially an asset manager where you're discussing on a regular basis with the property managers and looking at deals and having these kinds of these kinds of activities, are those activities that would qualify under the professional?
Absolutely.
Okay. All right. So let's back up here. So we've got three different classifications, and I just want to make sure we got this right here. So we've got passive, active, and professional. Mm-hmm. And the passive is limited to just whatever the income is, right?
Mm-hmm.
So
yes.
If you make 20, you can take 20 in losses.
Exactly.
The active, you can take up to an additional 25,000 losses. Is that correct?
Yes.
Okay. Now you mentioned some sort of an income phase out, or I guess I was referring to it, and can you talk a little bit about that?
Yeah. So if you're a single individual and your adjusted gross income is above $100,000, you can't capture that deduction on your tax return any further. It's just a regulation by the IRS. And then if you're a married couple at $150,000, it's phased out.
All right.
So that's why it's, some people can capture it, but many people can't capture it. And that's also why maybe it's not as well known as well.
So if you're not able to capture that, does it go away? Or are you able to carry that loss forward, or how does that work?
Well, that's a really good question. And in all three of these categories, you are able to carry these losses forward indefinitely and utilize them against any future gains that you may realize on the sale of the property. So you could also use that as a tax planning tool as well.
Okay.
But that would depend on your overall investment strategy with your real estate portfolio and how you're planning to divest your properties.
All right. And so if you have, and then the third level is the professional, where you've got to justify that the majority of your time and at least 750 hours a year are spent in real estate. And one of the activities you described, from developing, selling, leasing, managing. Am I correct?
Exactly. Yeah. And the definition sounds very general, and that's just because it is very general, and it's something that it's good to sit down with a CPA that's knowledgeable and make sure that exactly what you're doing you can justify and substantiate to the IRS. But as long as you're doing activities that are surrounding this working with the rental property and you meet the 750-hour requirement, then you're able to deduct 100% of your real estate losses against your ordinary income.
So in a situation where you are claiming that you're a professional, what's the record keeping requirement for that?
Well, it would really depend on the activity that you're performing and what you can do to actually substantiate that. But at the end of the day, you want to maintain some record to prove that you are doing the work. I always recommend clients keeping a time log at the very least to track the amount of time that they're spending on the activities. But in addition to that, if you have other forms of paperwork, whether that be property management paperwork, contracts that you're signing, things to show that you're working in a management capacity on the property, or things to show that you're working in a management capacity with the construction companies, whatever it is that you're doing. If you have other records to substantiate that along with your time log, especially if they're dated, that helps with the record keeping process as well.
Got it. So you mentioned the formation of an S corp for this activities. Is that a preferred to an LLC, or is this for the activities of the professional that you're trying to? Is that what? Can you help us?
Yeah, so the thing with S corps is, you want to be careful with forming those as real estate investors, and many people are probably aware of that. But when you are qualifying for this real estate professional status, that's subjecting the income that you make to ordinary income. So then that's subjecting your income to self-employment tax. So then you start to get into tax planning strategies on if there's any way to reduce the amount of self-employment tax that you pay. And S corporations are a fantastic way to do that by reclassifying some of your income that would be subject to self-employment tax as a distribution and allowing it to not be taxed at that level.
Is that different than an LLC? Is it?
Yes, it is different than an LLC. Okay. An LLC is simply a flow-through entity. So if you had an LLC, all the income would be subject to self-employment tax. But through different tax planning strategies with an S corporation, you can recharacterize some of that income and shield it from self-employment tax. Gotcha.
And make it more of a distribution, and that, like you said, is not subject to the self-employment tax.
Exactly. Right. And the self-employment tax is significant. It's a little over 15%.
Gotcha.
So the real estate professional status, it's very powerful, especially when you have losses, but it's not 100% the golden opportunity. You have to really look at it from a holistic perspective and incorporate it into your overall tax planning strategy and base that off of your entire investment profile and your financial profile, not just for the current year, but future years as well.
Got it. So are there any kind of parameters that one can look to determine, if these are issues of concern, or is there anything like that? I mean, obviously it's not providing tax planning advice here in this conversation, but I'm just kind of curious. Are there hints or signs that somebody should look and consider these other designations, or am I making sense?
Yeah. So I mean, definitely, I would always recommend consulting with your specific fact pattern with a CPA that's focused on working with you. It's really hard to give general advice that can fit for everybody, especially with something as situational as tax planning. And especially when it comes to real estate professional status and qualifying for it, the fact that the IRS does not statutorily list which jobs even qualify for the status creates a lot of ambiguity around the situation. So it is something you want to consult specifically with a CPA with. But the biggest benefit to the professional status is being able to capture these losses. So you want to make that your main point of consideration and balance that out with the fact that the income is going to be subject to self-employment tax. So you want to take those 2 points into consideration, and then next thing you would want to balance out your tax planning process with is what's your strategy on divesting these properties, and how would you want to capture these losses now, or maybe you can use them later. And what sort of gains are you anticipating from the rental properties as well?
Got it. So
now if you have, back to that first example, if you have a husband and a wife, and the husband has a W-2 job making $200,000, and now you can have the wife qualify for a real estate professional status working on some properties that they invest into. Now even if they run a loss, they can run that against the W-2 income. And it could be a very powerful way to reduce your overall taxable income. So that's one example of how it can be beneficial.
Right. And in doing that, if you, let's stay with that example. You got the $200,000 W-2, and you've got the wife who's now going to be a real estate professional. Would you, in the S corp, would that be something for ownership of the property, or is that more of the operations of the spouse?
Well, you can set it up. You can set it up that way as just for the operations. Okay, but at the end of the day, yeah, you can set it up just for the management. But at the end of the day, if you're qualifying for the real estate professional status, the income that you're making is going to be subject to the self-employment tax. So that's why you really want to decide: do you want to be taxed under this regime or not?
Got it. So
sorry, go ahead.
No, I mean, it's a little more complicated. What I was going to ask you, what are some questions? Can we kind of run through some questions people should ask themselves when kind of evaluating this?
Yeah. So first and foremost, when I recommend for any investment, and obviously to real estate investors, you don't want any strategy or any approach that you take to invest in to be driven by tax benefits. You want it to be driven by what is the best strategy for you as an investor for your overall financial profile, and what's the best way for you to maximize your profits. From there, I think after that, it makes sense to start to look at what is the best tax position for you to take and minimize your taxes and maximize your profits from that point on. So first and foremost, I would say that. After that, I would take a look at what your strategy is and see, are you falling into this criteria by default? Are you on the borderline? Or are you not even close to meeting it? That would be the first basis that I would look at. And then from there, I would look at how much income am I expecting from these properties? What is my personal financial profile? And how will the real estate professional status potentially benefit me in that regard? Maybe relate that back to the husband and wife example. Then you would start to take those things into consideration. You would also want to take into consideration how much, I'm not sure if I said this actually, but how much income you're expecting the property to make, because that's going to also impact your considerations around how you want to use the gains if you're not in that prior example with the husband and wife. So it gets very detailed and very granular, but at the end of the day, you're trying to see, how do I want to use these losses? How much gains am I expecting? and what sort of taxes is that going to expose my income to at the end of the day.
Right. No, it's real estate's an amazing opportunity to create some wealth and some income. But if you don't plan properly, you probably won't realize all of the potential for this. And it sounds like a little setup can really help you maximize your income. What are there any other kind of? I'm just trying to think here of signs to be that investors should look to or look for. I mean, I think what you're saying that makes complete sense to me is strategy. What is your ultimate goal in this? Because this is not something that you just set up one year and then you change the next year, and then this is kind of a long run plan. Am I right?
Well, yeah, because it's really going to affect how you're running your overall business and your overall investment portfolio. So, if you're qualifying for the real estate professional status one year and you're doing 750, 800 hours worth of work, I really don't see you backing out of that next year. But it can be something that one year to the next you don't qualify for the status. But then there's additional implications, because if the 1 year you qualify for the real estate professional status and you set up an S corporation, then you're going to have to dissolve the S corporation, and that's all costly to set up and dissolve. So really, with any time you're setting up a business, you want to set it up with a longer term perspective, because there's going to be costs associated with setting it up and taking it down.
Right.
So, when the S corporation gets factored into the tax planning of the real estate professional status, then you have to take those costs into consideration as well. But you can meet this status as a real estate professional 1 year and not qualify for it the next year.
Okay.
But you'll still be stuck in an S corporation.
Right.
If you have one.
Right. And when you say stuck in an S corp, meaning you've got to maintain the corp, and is that what we're talking about when you say stuck, or?
Well, you would have to maintain it, or you would have to dissolve it and possibly take a taxable distribution, depending on the fact pattern of the corporation. So that would be a whole nother issue to sort of address at that point. Okay.
So what about the investor that's been investing, whether it be actively or passively, and they're looking towards retirement, and and I guess maybe we should play this out all three ways, a professional as well. Now they're in more of a retirement mode, because ultimately I think if you go long term, what is the goal is to have more passive income. Can you describe how the transition from passive, active, and professional would, how it would change into a retirement?
Yeah. So at the end of the day, the qualifications are the same whether or not you have a job or you don't have a job. It's just usually easier to meet the real estate professional status when you don't have a job, because you have more time, and it's easier to also substantiate that that's where you're spending your main focus is on the real estate professional, is on the real estate rental activities when you don't have a job. So again, in terms of what's the most beneficial for a retiree or someone looking at retirement, it really would depend on their overall financial and tax profile. But in terms of meeting the criteria, it would become easier for them to meet the real estate professional status.
Based on the fact that would be kind of more sole activity to
exactly
or time to do that.
Exactly.
Got it. Interesting. And I'm trying to think. I've covered a lot of ground here with the different activities. What's is there a typical that you see for somebody that's a W-2 or the husband and wife, or do you see once people kind of understand it, do you see them kind of designating one as the professional Is there? I mean, if they're long-term investors, is there a pattern that you see, or you see more choose one versus the other?
Well, I do see a huge benefit with the scenario that I mentioned, and that's actually an ongoing case I have with a client right now, where the husband's a W-2 worker. He makes about, he's about $200K, and the wife's a stay-at-home mom currently, and they're going to qualify themselves for the real estate professional status and be able to take all the depreciation and any losses that they even realize from the rental against their income. And I really think that that's it's a very beneficial tax planning strategy for people at that level. Now, in terms of designating one or the other, one thing I would note is that in that scenario where the husband's working and the wife's not, the wife is going to have to meet the 750-hour requirement. You can't split that between the two. It has to be one person meeting the requirement.
Got it.
And now if you're filing married joint, you obviously, if one qualifies for it 1 year and one the next year.
Oh, really? So if it's married and joint, wouldn't necessarily have to be the same person meeting the requirement?
No.
From year to year?
It would also depend on whose name the property is in as well.
Got it. If all of the properties are held in joint names or LLCs or whatever that both are a party to, then that would that qualify?
Definitely.
Got it.
Because you want to make sure that you own at least 10% of the property, and you want to make sure that you're meeting the 750-hour requirement. That's really what the two qualifications are always going to come back to. So as long as you could substantiate that, you meet it.
Got it. So investors or people that are thinking of investing, I guess it sounds like the first place to start is, what is your plan, huh?
Exactly. Even before what's your plan, what's your personal financial profile, and then what is your investment profile, and then from there we could start building a tax planning strategy around that. That's really how we start to look at it, and we want to know where you're at right now, and we want to know where you're expecting to be a year from now, 3 years from now, and even 5 years from now. You want to take a short-term, a mid-term, and a long-term perspective when you're speaking about tax planning in general.
Got it. Well, this is huge stuff, because I think one of the things that people realize, one of the benefits of real estate is you have the tax benefits of depreciation and the ability to write off an investment, but as your income climbs, that if you're not set up properly, you're going to be capped in that, or as you grow your real estate portfolio, you're not going to have the ability to take that. It'll be there for you, which you pointed out, which you can use at a later date when you have a gain. But that's it's a big part of the real estate investment opportunity, is that depreciation and those expenses. And so it's clearly important to understand and have a plan so that you can take advantage of the rules to your benefit. So,
absolutely, yeah. It's a great tax planning strategy when it's fit for your overall financial profile.
Got it. Patrick, are there any other points we should make in this? I feel like we could talk about a lot of things, and I think before we wrap this up, I just want the listeners to know, I think you and I are going to have to do a couple more of these to talk, because I think each one of these topics has the opportunity to go a little deep, and we try and contain it a little bit here so it doesn't get too long and wide.
Definitely, like we said, there's a ton of tax benefits to real estate investing, and I think there's a lot of different areas that could be of a great interest to your listeners. A few things that we maybe can get into in later topics is record keeping and accounting and bookkeeping, because that's how you're going to be able to really maximize your deductions on your tax returns at the end of the day. Maybe just an overall conversation around tax planning, my company's approach to tax planning. And, I'm open to other discussions as well. But in terms of today, I would really just leave you with the fact that tax planning, it's very general. And when you're looking at any sort of specific tax planning strategy, whether that's the real estate professional status, forming an S corporation, doing a cost segregation, taking advantage of tax incentives, whatever it is, you want to look at that with the full perspective on your financial profile, and not just trying to direct your investments based off of a tax benefit.
Well, that's sound advice. Patrick, what's the best way for listeners to get in touch with you?
The best way to get in touch with me would be to visit my website. It's CamusoCPA.com. That's C-A-M as in Michael, U-S-O, CPA.com. And if you go to the Contact Me page, you can find all of my information there.
Got it. I'll list that in the show notes, and we will try and schedule one of these again soon so we can have a follow-up. Patrick, thanks for doing this, and we'll be in touch soon.
Absolutely. I really appreciate it. Looking forward to speaking again.
Well, death and taxes are unavoidable, but with the guidance of a trusted professional, you can minimize the taxes you owe and take advantage of the tax code to match your long-term investment strategy. For more information about this, I encourage you to reach out to Patrick Camuso. You can do that at CamusoCPA.com. That's spelled CAMUSO. CPA.com. Before we go, I want to remind you that if you like today's program, please let us know. It's really easy. You can go to iTunes and subscribe. And while you're there, go ahead and give us a 5-star review. When you do subscribe, you can listen anytime, anywhere. That's all we've got this week. Until next time, thanks for listening to Commercial Real Estate Pro Network's CREPN Radio.
You're listening to CREPN Radio for influential commercial real estate professionals. For more information on this or any of our guests, like us on Facebook, CREPN Radio.